All right, all right, all right. Welcome back to Project 321. You already know what we're here about, cutting through the noise, crushing the myths, delivering the raw, unfiltered truth about the world of home loans and real estate. Today, we're diving into a topic that doesn't just hit close to home, it is home. We're talking about the myths around VA loans. Now, let me set the stage for what's about to go down. If you're a veteran, if you're getting ready to sell your house, or if you're a realtor and you've heard the BS, VA loans are complicated, they're hard to close, or my personal favorite, zero down makes you weak. Well, today we're going to kill those lies. We're going to bury them 6 feet under and leave you with the truth that you need to hear. Now, I can't do this alone. Joining me is my co-host, my colleague, my guy, Tom Mancuso. The dude's got the passion, the knowledge, and the drive to make sure that you walk away today knowing more than what you did when you showed up. Tom, what's up, my man?
How are you, man? Thank you for having me.
Absolutely. So, joining us today is Leroy Romero. Leroy is a VA advocate. He's an absolute beast in the VA loan space, not just some guy who talks a talk. He's a Marine veteran and educator and one of the most respected VA loan advocates I know. Leroy's got this unmatched ability to make the most complex and intimidating parts of the VA loan process and break it down so easy even a 5-year-old could get it. He helped me when I first got into the business, and he's been a massive resource. So, Leroy, thank you for hopping in today.
I appreciate that. We like to call that Barney it down, right? Write it with crayons. Yeah. Let's break it down. Barney level. So, yeah, it's a pleasure to be on here with you, both of you.
That's awesome. Yeah. So we're going to do 3 things today. We're going to kill the myths about VA loans. We're going to show you some real value and opportunity behind those benefits. And we're going to arm you with the knowledge to make smarter moves, whether you're a veteran, a seller, or a realtor. So if you're ready for some raw, honest, no fluff conversation, you're in the right place. Let's get into it. Tom, you ready to do this?
Yep, let's do it.
All right. So let's kick it off, Leroy. Why do people still think that zero down makes them look weak? What do you think the background is to that?
Well, I've often heard, yeah, and what's crazy is that we still hear that today, right? What's the skin in the game? So there's this perception out there of skin in the game. What's the money, right? So when you think about as a seller perspective, when you're receiving this offer, you've got 20% down conventional, 5% down conventional, or 3.5% down FHA, and then you get this VA offer that's zero down. And so from a seller's perspective, they're saying, well, they're not putting anything down. Where's their skin in the game, right? Well, their skin in their game is their service. Like there's no more skin that you can put in the game than that. So it's an entitlement, right? So they serve their country. They have this specialty loan product where they don't have to put anything down. So I think that perception really comes from a seller standpoint, right? Or maybe who's representing the seller, like an agent. Well, it's listed cash, conventional, FHA, but no VA. Why? And so a lot of the times that I've seen over the years as I've been teaching is the consumer is just uneducated, the seller, in that aspect of zero down actually can be more powerful because there's more flexibility in income when it comes to things like appraisal gaps, right? Bid asking. So when you really break it, the numbers, which I know we'll go into another question on that, but I think that that's the biggest myth is the education on the seller side, but mainly the seller's agents is understanding that zero down does not make a weak buyer. Zero down is the entitlement that a veteran has in that flexibility of 100% financing. So that's a great question.
Right, and I'm going to make an echo, kind of make a 2-part question here. Why aren't more veterans realizing they're sitting on one of the most powerful buying tools when it comes to owning a home, and what's stopping them? But then I have a second follow-up question to this.
I like that. I think of when, and it's been a while, right? 1997 since I was in the Marine Corps. So I think when you look at the majority of the veterans actually use their home ownership benefits after service. Sometimes they forget about that service, or maybe they had some complications with the VA. But when you're getting out, right? Like I just want to go home. I want to get out. I want to get done. I want to move on with my life. And so they might brush across the topics of the VA loan, but they really don't dive in when you're active duty service of how does this benefit? How do you build generational wealth while you're in the service and out of the service? So I think it really comes back to lack of education, not only just in the, I would say, in the parts of the military, but it's even after that. So we forget it, we do it, we go home, we get a job, get placement, we go to school, and then we kind of forget about that benefit. So I think it's the really lack of education on why veterans don't understand like the huge benefit that they can do, or the benefit that they can have as they're in the service.
So you really kind of hit the nail on the head for my second question. But you know what's funny about that you bring up? It's actually not funny. It's very frustrating. The VA charges a funding fee for non-disabled veterans. I believe, and you can correct me, some of that funding fee does go to the VA, right? It helps provide some of the veteran benefits that veterans get post-service or during service. You would think that the VA could use some of those funds, or even community nonprofits, to come help teach active duty military service members about when they're about to get out of the military, or even while they're in the military. Hey, you serve this country. We want you to own part of this country, like that you serve. We want you to really, truly plant your roots in this country and feel like you earned that right. And so here's the benefit that you have earned by serving this country with the VA home loan benefits, and walking them through and teaching them about that. So that's the first part. But you said education, right? So that would be great. I'm sure that's on a long list of things that we would have to petition get politicians to buy into. But the education portion, and in my experience, some education is jaded, right? People have education for their own monetary benefit with certain companies, or even what a lot of veterans don't understand is just because one company has certain guidelines or restrictions on a VA loan, that might not be what the VA actually has. So what would be, if I'm a veteran, and I'm not, but if I was a veteran and I wanted to learn about a VA home loan, give me some examples of where I could safely go, where I'm not going to be lured by monetary gain by the people providing me those benefits. I know you're going to probably mention there's some Facebook groups with tons of great material, but where are some good options that a veteran can go by themselves, ask questions, look up guidelines, or look up information about a VA loan without getting the sales pitch at that time?
That's a really hard question to answer, because the truth is everyone's going to be solicited on something. So whether it's a private Facebook group, if you go online, there's certain companies that own the internet. So you can do the research. I just wouldn't click on any ads. I think that's the biggest thing. So, I mean, obviously there's places like VetaVA, obviously is huge on education with no solicitation, very strict boundaries on that, where they can ask those kinds of questions. That's probably the best source I would say out there. There's veteran mortgage advisors that share that information. All this information is on the internet. So YouTube's, things like that, I just would caution the veteran to, if they're going to, and YouTube's huge, right? I just changed my oil. I haven't changed my oil ever, but I did it through YouTube. So getting online and learning those, basic common questions that you have, or finding groups. I think realtor resources are great. Do they have the education or a pamphlet per se that they can go through? Well, it's just going to highlight some things. But having, network in the community, referrals, I think referrals are huge. People that have purchased with a real estate agent before or a lender before, that walks them through those things. I would just be very, very leery if I was coaching you as a veteran. If you're going to go online and get education, I think that's good. That's kind of where we all get our education from. And so I would say, Tom, don't click on anything. Don't click on any ads, anything like that, because then you're just part of the matrix, right? You're part of the funnel. You now become a lead, and it's the transition to get you by or refinance or whatever it is. So could we see some, to answer the first part of your question, it would be amazing if the VA would actually put a portion of what we're paying on certain things into education on base, right? And it doesn't have to be somebody. It could be a civilian that's going out and educating. There's somebody with credentials to actually go in and educate these veterans, I would say probably E2, E3, E4s, right, or O1s, officers, right? And so that would be ideal. And you really said an important point, that the funding fee, going back to that funding fee, right? The funding fee is set up for displacement veterans. The part of the funding fee, which was an increase back in 2019, I think it was, for the Blue Water Bill, that actually paid for additional benefits for veterans, medical stuff. And so that's where that funding fee comes in, is it's to prevent foreclosures, possibly, veterans assistance with home ownership, medical increases with the Blue Water Bill. And so sometimes you see that fluctuation, right? The funding fee came back down recently in that particular bill, but that's really what that funding fee is. And all veterans pay that funding fee. You don't have to be 10% or more. If you are service connected and receiving disability income, you can be rated at a 0% and still be exempt. Everything's going to fall on that certificate of eligibility. And that's kind of the ledger, right? The golden ticket to say, hey, I'm exempt from this funding fee.
Yeah, I think a term that we use in this industry is trust but verify, right? And so that does apply here. I think veterans doing their own research, but then, like you said, whether it's Facebook groups or different entities, asking those questions, verifying, see the response that you get. Don't just trust one source. Don't just go to a for-profit, whether it's lender or real estate company, and click on the ads and say you want information and get sold on that. So unfortunately, you kind of have to be your own advocate at this point in how our service to veterans is set up. That's unfortunate. Hopefully that will change, but knowledge is power, right? That's the bottom line. Now, knowledge is power. And so thank you for that. That's good information.
Yeah. Speaking about the funding fee, Leroy, some people can look at it and I don't know, maybe it seems kind of scary. They don't really know how much it's going to be, how it's going to affect their loan. But if you compare it to, like, say, an FHA loan or something like that, that's going to have permanent mortgage insurance, like, it's not really that scary, right?
I don't think it's scary at all, right? So if we have somebody that has first-time use, it's 2.15%. It can be financed if you have seller concessions. It can be, or even if you don't have seller concessions, it doesn't have to be financed. It can be paid in cash. It just can't be partial, right? Can't cut it in half or anything like that, but it can be paid. So what it does is it goes on, Tommy, is it goes on the top of the loan. So I have a $300,000 loan and say my funding fee is $6,000. My loan's actually going to say $306,000. That is such a fractional difference in a mortgage payment when it comes to comparing to FHA loans, right? You've got your FHA loan. I think it's 0.85 or so. Don't do a lot of VA or FHA loans, so I'm not sure on that one. But when you break down, and that's for the life of the loan, until you refinance that, you're paying that FHA, right? Or in a conventional standpoint. So you only have 5% down, you want to go conventional, 5% down. That's going to be a healthy mortgage insurance or PMI that you're going to be paying until on the conventional, you're at 78%. It's really not 80%, 78%. And then you can petition to have that mortgage insurance dropped. So when you look at how many months that would take to pay off an additional 17% on a conventional loan and get that principal balance down compared to a VA loan where you have the funding fee is really not a huge factor. When we go into subsequent use, though, that's important. Let's just say you're working with a veteran, or a veteran says, hey, you know what? This is my second time use. I used my loan to buy in Arkansas 50 years ago. I don't have any disability, so I'm not exempt, but I do have money down. Well, the great thing about that funding fee, it can actually be reduced to 1.25% by having just 5% down.
That's great.
So with a veteran's entitlement and no PMI on a VA loan, what is it exactly that the VA is doing? Why are the interest rates better? Like, what is the VA the one who issues the money? Can you break that down for some people who just really don't understand how that works?
Yes, yeah, absolutely. And that's a really good question for veterans out there, right? Because hey, I've got this certificate of eligibility, I've got my VA loan. Well, the VA doesn't loan money. That's not how it works. They guarantee money. So for the banks or the investors that are servicing the loan, and that's 25% guarantee. Right? So going into the certificate of eligibility, every single certificate of eligibility is going to say $36,000. That's that first level of entitlement. I might be jumping ahead on some questions, but that doesn't mean you're approved for 36,000. That means you have a first level of entitlement of 144,000. Then you have bonus entitlement above that. So when you talk about subsequent use, whether they foreclosed, whether they had did in lieu of, whether they had an assumption, they have more possibilities to be able to continually use that, eligibility. I don't know if I answered your question. Sorry, I just hit my knee there. But I think that the education around the certificate of eligibility is huge. And that's probably the first thing I would say. The first question I would always ask is, are you a veteran? And it doesn't matter if I'm talking to whoever I'm talking to. Are you or your spouse a veteran? Or are you a veteran? Because you never know. Even though it's on the URLA, right? Now you got to say, hey, military service. I've seen rescue deals where they've been put into an FHA loan and they're a veteran. And I'm going like, wow, it's literally on the application. And it wasn't marked. It wasn't marked. So you got to dive deep. So that first question I would always ask any consumer is, are you or your spouse a veteran? Because then that allows me to say, okay, let's look at that VA benefit. So to answer the second part of your question, Tom, was why is it different? Well, we're dealing with Fannie Mae and Freddie Mac, right? That's our underwriting system. And then we have Ginnie Mae. So when you have government-backed loans, they tend to run anywhere from a quarter all the way up to a 1% difference in interest rate compared to a conventional loan. Why does that, or how does that work? I don't know, maybe because it's government-backed, but those particular pools, I'm assuming on the back end, are sold mortgage-backed securities. They have different pooling that maybe provides a better rate or so. But yeah, generally it's going to be anywhere, I would say about 0.5% difference than a conventional loan when you look at the overall just interest rate in general.
Yeah, what I was looking for was that the VA guarantees 25% of the loan. And so without putting money down, without required mortgage insurance monthly or upfront, the VA is guaranteeing for every veteran who qualifies 25% of the loan. And so that's a huge benefit. And I know we're going to get into, denial rates and default rates later, but that also plays into that, why the government does guarantee that.
Yeah. Why would you say there's a myth around VA appraisals, that they're bad, that it's not going to pass a VA appraisal? That's a kind of a common misconception, I think, with realtors out there right now.
Yeah, I think when we talk about myths, right, we talk about, and I think about my dad, right? My dad hadn't used his VA loan since ever. In 2008, he used it for the first time. He had bought 7 different homes before 2008, never used his VA loan. And so I think in a period of time, not that since I've been originating loans, is there was this kind of this myth of, hey, conventional loans are easier. They don't have some of the safety requirements. And that's really not the case. All appraisals. Now there's quirky things, right? You can't have exposed wires. You have what's called minimum property requirements. Even if you're doing a conventional loan, you have chipping paint. That's still going to be a problem. You're going to have to paint it. Doesn't matter who paints it. Go out there with some kills. As a loan officer, there's been times where I've painted the railing because it was chip and paint in 1978. So I think that those myths come from a long legacy of agents that have been in the business for such a long time. When we think about the average age, and I don't know the exact stat, but I do remember it was in the upper 50s was the average age. Well, that's a long time ago. So that, I think it's just been passed on, right? Like an old story or a folk tale. But no, the VA appraisal is actually pretty easy. The one thing I do love about the VA is when it comes to appraisals, we have the timeline. Here's the timeline, here's the expectation. And it's held accountable. So like in Arizona, which is where we're all at, maybe not in Kingman where you're at, but where Tom and I are at in Maricopa County, which is the largest county of actual VA loans in the nation, our appraisal turn time is set. It's 7 days. So 7 days from assignment. Loan gets assigned, or appraiser gets assigned. Appraiser has 7 business days to get that in. So now we have an accountability checklist. So, okay, when can we expect the appraisal? Well, 7 business days. We have a timeline. Conventional FHA do not have a timeline. You don't know. What if it gets busy, right? What if there's a shortage of appraisers? And what we're seeing, Tommy, is, again, a huge advantage for veterans in this case in using their VA loan is there's no AMC, right? So nobody managing an appraiser to go out. Everything's regulated through the VA. So when we collect $650 for a VA appraisal in Maricopa County, that appraiser makes $650 versus having an AMC, a management company or appraisal management company, right? Maybe that appraisal is $500. Well, the appraiser's maybe getting $300.
Yeah.
So
I know back in like 2020, 2021, it was taking, 30 days, 45 days, for conventional appraisals to come back, sometimes longer. Prices were getting jacked up, $2,000, $3,000, for stuff. So I know that's a huge benefit to the veteran to have that capped and have those timelines capped as well.
On the appraisal question, two follow-up things. So in my experience, the whole, VA appraisers are more nitpicky and call out things that shouldn't be. I remember about 4 years ago, I had a active military couple moving from Nebraska, getting transferred to Davis-Monthan in Tucson, Arizona. And I remember when the appraiser went in, we got the report back. It said subject to. It said the home does not have working smoke detectors. It needs working smoke detectors. And the buyer's agent, who's supposed to be the boots on the ground, helping them because they're still stationed in Nebraska, calls me and is furious that this is called out. Now, understand, this is a husband and wife, active duty Air Force, 2 small children, and the buyer's agent is upset that the VA just wants smoke detectors in a home for the family's safety, excuse me. And I just could not believe that was an issue. And at the same time, I just closed a loan for a military couple, veteran couple in Missouri, where the house had a couple steps to the entryway, just 2 steps, but there was no railing, right? And most times the VA will require that stairways or stairwells have a railing. But because there are only 2 steps, the appraiser even noted on the VA appraisal, there's only 2 steps. There's no guardrail that needs to be there. There is a post if someone needs to grab that. They didn't call that out. They used common sense when writing that appraisal. And so that those are true myths. Maybe over time, things have changed with older agents, things like that. But Leroy, can you touch on what is the difference between a VA appraisal when it comes to value versus conventional FHA or any other type of appraisal? So I'm buying a house, it's selling for $500,000, but it's not going to appraise for $500,000, and we're using a VA loan on that property. What's the difference that will happen with that type of appraisal versus if I was using a conventional loan? Can you explain that for people?
Yes. So what I think you're talking about is what is that appraisal process, right? We always want to look at safety and hazard concerns, and I want to address one question, and I'll get back to that one. Is when you think of appraisers, conventional, FHA, VA, think of it this way, and not trying to offend anybody that didn't go to college, but in this case, just additional education, right? Conventional, super easy. I graduated high school, right? FHA, cool, I went to community college. VA, I graduated from the University of Appraisals. So there's so much education that goes into actual value comps, what we're looking at, and which leads me into the next piece is when you're at that level of education, when it comes to VA appraisers, the way that the VA has it set up currently is, let's just say, Tom, that you're buying that house and that appraiser goes out and it doesn't look like the property is going to be at value. So you get the first option to do what's called Tidewater. So the lender will get receiving an email, right? They'll get an email over, and it'll be from the appraiser that says, hey, we're issuing Tidewater. Tidewater is the appraiser saying, it's not a bad thing. It's the appraiser saying, hey, I need some help here because the way you price this property, I'm not finding the comparable sales. So I need your help, Mr. or Mrs. Agent, to be able to help me find those comparable sales so I can understand the value. Well, Tom, that property has a pool, it's got granite countertops, it's got updated kitchen, it's got all of these different amenities than what maybe the house does next door that was a comparable sale. When you start to add those things up, well, now we've got this particular comp and these values, so you can do that. So at that point, we submit over 3 comparable sales to the appraiser within 48 hours. I usually say 24. Bam. The appraiser at that point can look at those comparable sales and say, okay, we meet value. Well, what if they don't meet value? Then what? So the VA has 2 options to rebuttal the appraisal. The conventional loan doesn't, FHA doesn't. What we are seeing, though, is in the future, we're probably going to see conventional and FHA adopt that same method of what's called a reconsideration of value. Reconsideration of value comes back. Tom, house came in at $450,000. As your loan officer, you're like, hey, no way. Boom, I'm going through and finding comparable sales. I'm matching up the appraiser, our appraisal for the amenities are here. And then I'm going to submit that over to the SAR, which is the staff appraiser reviewer. And they're going to submit that over to the VA. And the VA is going to take a look at it and they're going to go, wait, this has a pool, this has granite countertops, a little bit more square footage. Yeah, we're good. We're good with the $500,000. And so they have that option. And right now I believe it's 89%. I'd have to fact check that, but reconsideration of values that are getting approved. And it used to take 15 days. In the regional loan center where we're at in Phoenix, all of us, it's 5 days. It's very fast. So we're seeing an increase in reconsideration of values because what happens, the market's moving so fast, the appraisers are sometimes not keeping up with the projected values of what we're seeing here in Arizona. That answer your question?
Yeah, that was great. I was in for Tidewater and reconsideration of value, and that the VA has the ability to step in. Where you hear, oh, I got a bad appraiser. You know what I mean? Well, that doesn't matter because the VA, again, it's not an independent company. It's the VA that's helping managing it, and the VA ultimately, Leroy, tell me if I'm correct on this. The VA is there to help a veteran become a homeowner. They're not there to prevent a veteran from becoming a homeowner. Sure, they have guidelines and there's things that need to follow, but they're there to help a veteran. And so that's a big thing. Thank you for that.
Yeah, the VA can actually override the appraiser's opinion, which is huge.
Yeah, that is really big. So, Leroy, what do you think would cause a homeowner or a seller, or maybe the seller's agent, to think or have the myth or the misconception that VA loans are bad?
Well, I think there's a couple things there. I think we're dealing with age, education, the whole skin in the game, no down payment, right? Because it really doesn't matter because the down payment's not going to the seller, right? It's going to the financing company, and that's considered the loan to value. So that's kind of a moot point. Let's go into the denial rates, right? So what are the facts on the denial rates? They think, oh, well, the VA is going to get denied or whatever. Well, in reality is the VA has a very strong stance on underwriting. Strong stance meaning that we really look at residual income. That's income left after expenses, right? That everybody knows or should know what debt to income ratio is. So your total debts, your housing debt, and then your total debts combined would equal your debt to income ratio divided by your income equals debt to income ratio. Right? So we're capped. Fannie Mae's at 49 point whatever. You maybe go to 50, and then 50.5 is LP. So which would be Freddie Mac, and then you have FHA. There's a certain max there, 56.9. Well, VA doesn't have that restriction at all. Now, if you get into a manual underwrite, that's another topic we could spend a day on. But the VA, if it's what's called approved eligible or accept approved, with the different entities that we run underwriting through, the VA doesn't really have a debt to income ratio factor. So really when it comes to debt to income, that shouldn't be a problem. I think when they look at denial rates, I'm leading into that as far as denial rates, but VA actually has a denial rate of, and we're talking from loans, applications, denial rate. Okay, so once you actually have an application, you have your loan, and then you have the denial. We either approve or we don't approve. Okay, so from conventional, and this is last year's stats, these have just been updated, but I'm going to go with 2023's data on it, is FHA was a denial rate of 11.8%. Conventional loans, 11.2%. USDA, which is a government-backed product, 11.2%. VA, 7.2%. It's a 4% difference in a denial rate, meaning the VA is approved 4% more than what a conventional FHA or USDA loan would be. So why does a seller think that, hey, this is going to be a hard deal or it's not going to go through? It's just not true. I think it just comes from a legacy of lack of education. And I want to say, Tommy, is that when you look at veterans or VA loans as a whole, I think only 18% of veterans actually use that VA home loan benefit based off of time and education and knowing that it's there, because it's definitely by far the best loan out there.
You know, additional factors I think that you can expound on, minimum credit score requirements for a VA loan and why something called a compensating factor is a thing on a VA loan, but no other loan that I've ever seen. Can you explain the credit score that VA requires and then what a compensating factor is?
You bet. Well, the VA technically does not have a credit score, right? So there's no requirement. There's nothing that's in the 26S7, which is the VA lender handbook. That's what all lenders have to go off of for their underwriting guidelines. And so there's not a credit requirement, although there is an investor requirement. So investors is what are they willing to do for the risk of a credit score? So we have certain automobile companies out there that try to play in the VA loan space. We have companies out there that changed their name in 2012, put veteran in it, and they have what's called overlays. And so while the VA doesn't require a credit score, our investors, we all work at the same company, right? We have investors that, I think we can go down to, I think the lowest we've gone down for me personally is 560, right? But I know we have investors that can go down to 500. And we'll talk about compensating factors here in a minute. So that overlay is the investor saying, hey, our risk threshold is right here. So we're only going to approve veterans at 640 and above. So what happens is when you remove some of those overlays and you have like I would say a broker, in a sense, a broker is somebody that can shop multiple investors to be able to place a VA loan. Some of those brokers don't have overlays. So they're able to really genuinely underwrite towards the 26-7, but they still will have some requirements when it comes to credit score. Now, if for some reason that we have to go into what's called a manual underwriting, so even we have investors that super low credit score, 560 manual underwriting, that's when the loan is not approved eligible. It's refer eligible. And what it's referring to is there's something going on in the credit history where it's not liking the decision. So the VA allows for a manual underwrite. The manual underwrite, the veteran has to go through a series of compensating factors, like what Tom said. Compensating factors, you have to hit, I think it's 3 of them that you have to have. And those compensating factors are going to be job history, credit history, if you have VA disability, any additional income resources. So there's a lot of those factors, but the VA is saying, hey, underwriter, open up the book and see if it hits these particular guidelines. And if they have 3 compensating factors, then we're good to go. Then we'll sign off on it and they'll guarantee it. So what the investors really wanting to make sure that they have, I would say why some of those companies that I talked about, They want to make sure that that loan can be guaranteed, such that if something happens, like a foreclosure, they can be reimbursed, which is where that 25% guarantee comes into play.
Yeah, that's perfect. Thank you for explaining that, which is crazy because no minimum credit score, still a higher approval rate, but yet a lower default rate than any other loan. So, and it really just goes, it's a testament to the type of borrower and man and woman that serves this country is the bottom line.
Yeah, 100%.
When it comes to sellers, there's a myth, a rumor, I don't know, a belief, I guess, that they have to pay all these fees if it's a VA loan. Where do you think that comes from? Because that's not really the truth, right?
No, it's definitely not the truth. They don't have to pay anything. But I can tell you this. I don't know how long you guys have been in the business for, but I started on the prime side in 2009. And in the Arizona contract, right, because we're in Arizona, I don't know about the other states, but in the Arizona contract, it stated specifically, seller to pay escrow fee on a VA loan. So they abolished that. They got rid of that. But when it comes down to, can the seller or does the seller have to pay certain veteran fees? No, not at all. Let me ask you this. We have a termite report. And for some reason, like the termite report comes bad and we have to have termite treatment, it's $800. Is the seller required to pay it, or can the veteran pay it? The veteran can pay it.
The veteran can pay it, yeah.
They can pay it. Yeah, they can do that. It's the same thing on the termite. The veteran can pay all of those fees. It's up to the negotiations and depending on markets on whether or not they want to ask for seller concessions for particular fees. But they are not required at all to pay any fees for the veteran. The veteran can pay all the fees.
So when it comes to fees, what are the fees that the veteran can't pay, or maybe they're capped at?
So there's, and we don't know, I mean, the market's kind of changed a little bit, right? So market meaning with the whole NAR settlement stuff, like the one thing the veteran couldn't pay is commission fees to an agent. Well, now they can, right? So based off the buyer broker, everybody has to have a buyer broker. So if there's a gap in concessions or seller paid, because traditionally the seller would be charged, let's say 6% to list the property, 3% goes to the buyer broker, 3% goes to the listing agent, but the seller was always the one that had to basically pay up front for this amount of money. Well, now with the new change, the veteran can now make up that gap if that's part of the contract and that's part of the buyer broker. So we just saw that recent change, and that just happened like a couple months ago, where the veteran can now pay those fees. But when it comes to what's called non-allowable fees, that can be, and I don't have the list in front of me, but like the escrow fee is one of those, processing fee, underwriting fee. There's certain fees that the veteran cannot pay if and only if the lender is charging a 1% origination. If it goes over 1% on total fees, then all of those fees have to be absorbed by the lender or paid by the seller or the agent.
On the termite and some of those fees or repairs, this is another advantage of the veteran not having to put money down, because typically they have financial resources to negotiate that, where they might cover some, the seller can cover some. I mean, I think that gives another arrow in the quiver for the veteran, because they have a little bit more flexibility on what they can, pay for and negotiate. One question that really for borrowers, agents, but actually even sellers, because if I'm a seller, one of the questions I'm going to ask my agent when they get a pre-qualification from a veteran who wants to buy my home is, can you explain, Leroy, the difference for agents, borrowers, sellers, everybody? What is the difference and what is the advantage for a veteran borrower from using a retail lender, what a retail lender is versus a broker, and how that can play into helping the veteran know? We talked about guidelines and overlays and different investors. When you talk about an investor is the company that literally funds that loan and pays for that loan. But can you explain the difference between a retail lender and a broker and why that would help a veteran?
Yes, absolutely. And there's really kind of three channels, right? So we've got the banks, the Wells Fargo's of the day, Bank of America, the Chase, all those. So that's one entity, right? So it's the banks. The banks funding, they're doing their stuff so they can manipulate the rate sheets of what they want because they're the primary investor, right? And then you have what's called a retail company. A retail company would be a company that funds in their own name, but they have several warehouse lines, but they only have designated warehouse lines. A warehouse line is like a big credit card. I got this credit card, but I'm going to do this loan in Leroy Mortgage Lending's name, right? So they got this big credit card, and then what they do is they have certain investors that buy their loans, and so they can manipulate the rate sheet in a way. And then you've got what is called a broker. So what a broker does is they have several different investors where they can come in and choose. And sometimes rate's not always, I would say, it's great to have a great rate, but it's great to have great service. When we're moving in a fast-moving market like this, if we have particular investors that, yes, we can close in 11 days, clear close in 11 days, clear close in 21 days. It's important on that because sometimes that contract gets accepted based off of how it's kind of like speed to lead, right? So if you can move fast, they might be a little bit higher in pricing, but you're going to get it backed up with the service and speed. So a broker has that option to be able to help the consumer choose, hey, do you want the best rate? You're always going to get the best service with me, but what are we doing with time frame? So we've got this rate. Well, this particular investor is kind of clunky on here, but this investor moves very, very fast, but the pricing is a little bit higher. We're dealing with a short close, so this might make sense if it's a difference in 4% rate. So I think that the consumer has to understand that when you're dealing with a mortgage broker, is you have several options, and you're not just steered to one entity on what a retail bank would have or a banker would have, because it's going to one spot only. Boom. You don't have any choices. It takes away the choices from the consumer when you're dealing with retail lending, in my opinion. So the broker has the ability to shop the rates and service at the same time.
Yeah, I remember during the COVID era when real estate was going crazy and the world and the country was dealing with a lot. There was a lender, a federal credit union lender. I'll refrain from saying their full name, that because of the volatility in the economic market raised their minimum credit score, their overlay, up to 680 for veterans who were under contract. So if you were 659, you no longer could do your loan. It didn't matter if you're a week from closing. You could no longer do your loan there. Where we as a broker, maybe some of our lenders do have additional guidelines or overlays, but that is the job of a loan officer, a professional loan officer, to find which lender is best suited for the client. We're not trying to stick the client the square peg in the square hole. We can match the lender to the client, which is completely different than a retail or a depository bank, where they have to find the borrower that fits that perfect, that perfect idea of what they want to lend to, where we have so much more flexibility and so many more options for the borrower. And again, if I'm a seller, I know that gives the person I'm selling my home to more options and the ability to purchase a home with better odds than maybe at a retail lender or a depository bank, because they're not limited to so many different overlays or restrictions. So yeah, thank you.
I like that you brought that up, Tom, because I think about things at night, or how can I be better? How can I serve more veterans, more agents? And what kind of keeps me up at night sometimes is I think about how many people utilize automobile companies, right? Or companies that change their name, or federal credit unions that have this overlay, which is usually it's either 600 or 640, right? So 640. So if I go back into 2000, let's just say 2020, 2020 was just a phenomenal year, right? Everybody's buying houses, we're doing that. And how many veterans were denied and not thinking that they could purchase because they had a 639 credit score? And so they get this, belief. It goes back to the ham and the pot story, right? Well, why do we always cut off the ends? Well, that's just the way we've done it. Well, okay, just get a bigger pot. Like, that's crucial to me. So I think about that when I think about education, that's probably why I like to educate as much as I can, because there are so many veterans that were probably turned down during that process at a 639 or at a 599 credit score, where they could have literally changed the entire trajectory of their life through equity position 4 years later, if we're talking about today. So those companies are not advocates when it comes to the VA loan. In my opinion, the veteran's just a number, and we're not. We're people. We have families. We want to grow our net worth. We want to do those. Sometimes we might have low credit. And so pairing up with a mortgage broker that has options is the true value for the veteran, because they can start to build generational wealth.
Absolutely. Leroy, talk a little bit about how a seller or maybe a seller's agent can actually take advantage of VA loans, specifically renovation loans. If maybe home's a little older and needs a little bit of rehab, what are the options there?
That's an awesome question, Tommy. I think from a seller perspective, when we look at, let's just say we have some exposed wires, chipping paint by the pool, carpet's nasty. And so I've got this listing where I'm like, I'm not going to get full market value off of this. I'm going to probably have an investor want to come in, buy it cash, do a flip. Well, the VA has a VA renovation loan. And so listing agents could take advantage of that if they understand that from the listing perspective, is they don't have to list it as cash and conventional, right? Or FHA. They can come in and say, the VA renovation loan is acceptable. And it's a pretty easy process. I'd plan on a 30 to 45 day close, but the veteran can actually finance those options in and find the location that they like, find a house that maybe they don't jive with because of its, not updated or anything like that, but they find the location of where maybe they're 5 miles away from work, right? It's a great school area because that comes into play a lot of times. Or maybe they just like the general area, but the property is outdated. We see that a lot in like downtown Phoenix, right? So yeah, the veteran can come in and write that offer, but from a seller's perspective on how they can offer more options to their client as a seller is to allow that VA loan, VA renovation to happen, because the veteran can come in and all that. It's a pretty easy process. So the biggest thing is obviously you got to get the bids. You want to work up the projects, and then that appraiser will have, hey, here's the list of bids. Here's where the contract's at. And this is what we're projecting the value to be. And then the appraiser will take those additions into consideration for the value. So
awesome. Is there a limit? Yeah, is there a limit to what they can do as far as renovations? Like, we're in Arizona, it's hot. Can they put in a pool?
They cannot put in a pool. There's certain amenities. We would love that. But as far as there's limitations on there's certain things that you can do as well. However, what they can do is go up to, I think we have one investor that's up to $100,000, but anytime you go over $50,000 of upgrades, then you would need a HUD consultant. I would always recommend a HUD consultant because that's kind of like the buddy check accountability person when it comes to the contractors as well.
Awesome.
There's another specialty VA product for the market we're in, especially. There's not a lot of homes on the market, but a veteran may have specific taste. They may want to, even customizing their own home or renovating their own home may seem like not enough. Maybe they want to build their own home. Can you talk about what options a veteran has for building their own home, or what the VA calls a one-time close construction loan?
You bet. So the land is considered on there. You can purchase the land. That's one of the myths out there, is the land can be purchased with the construction of a new home. And so how that works with it's called one-time construction for a reason, because it's just one loan. So you go through that whole entire process, you close on it, and then you start to have that build. It's definitely a lot of work that goes into it. But the veteran can find property on there. They've got to find a builder, have the bids, permits, stuff like that. All of that stuff could be, there's portions that can't be financed into it, but yes, that can be financed into it. I get the question on tiny homes, right? I just had that question the other day. I've been searching for a million different investors. Tiny homes, yes. if they can be stick built like a barndominium, you get that question all the time. And as far as financing wise, the biggest thing is going to come down to comparable sales, because we're starting to see it a little bit moving, and it'll be interesting to see what the VA does with this for guidelines, but moving in that direction of these tiny homes. That's probably the biggest one I've come across like in the last couple of weeks is what does that look like? Well, it really comes down to comparable sales, but if it's a unique property, you're going to have those comparable sales in that particular area that match it. It's got to be alike, right? You can't pull a single family residence or a mobile home to compare it to a tiny home. It's got to be a tiny home. So yeah, there's lots of options on there. Back to the renovation refinance, renovation loan, because I want to talk about refinance on that, is you're in an area you like, you've been living there for 10 years, your house is outdated, you have a couple options. So those options, one is you can do a renovation loan, you just do a renovation refinance loan, or you can do a cash out option. It really depends on what you want to do if you're in that equity position, but that's also available. If the seller or if the consumer doesn't want to move, those options can be financed.
That's great to know. Now, if they already have a VA loan, they can just go ahead and still do that, or how's that going to affect that? The veteran's already in a VA loan.
If they're already in a VA loan, that's okay. It's going to be treated as just a brand new VA loan and utilizing new entitlement. So obviously, if you're pushing up that entitlement, same thing as what a cash out refinance would be. And we're seeing a lot of cash out refinance right now, especially when you think about the economy. We all see these reports, right? Woohoo! Fed just dropped 0.25%. Oh, great! Mortgage rates just
went up.
Dipped. They didn't dip; they just went up, right? We just got hammered on bonds, and so the perspective for the veteran is consumer debt is an all-time high, and they might be really excited about that 2.25%. Well, you know what? I was really excited when I was at 7% body fat. That's just not it right now. It's not happening. So I got to do, a body refinance. And so what I'm going to do is I'm going to take out all the sugar or alcohol or whatever it is from my house, because I know if it's here, I'm going to eat it or drink it, right? So I got to get rid of that. It's kind of the same thing with consumer debt. Get rid of the consumer debt. Yes, 7% body fat was super sexy. So is 2.25% or 3.25%. But what's not sexy is 27% on $20,000 in debt, because it hangs out there. So I think the biggest thing with that is going to be, working with a professional and really crunching the numbers. And you don't have to be on a 30-year loan. You can drop that down to a 15-year loan. Maybe the rate's better at 30, so pay it on a 15. Pay it on a 20. Whatever you're going to do to be able to stop the revolving debt from climbing, just like our debt ceiling that we
have. Yeah. You touched on refinances, and so this is something that I want to talk about because we do a decent amount of VA loans, and a lot of my clients tell me, "Hey, I just got this in the mail. It's a postcard, and it almost looks like it came from our company because it says like RE Amerifund Loans, or in relation to your loan with United Wholesale Mortgage or whoever, Equity Prime." And so I wanted you to touch on, first of all, how are other lenders soliciting borrowers with these advertisements? Like, where are they getting the information? How is it available? And then also touch on, there's an old term that exists, but really was prevalent years ago, called churning loans. And the reason why I want you to talk about this now, people are going, "Oh, rates are too high to refi right now." Yes, but we're hopefully going to be in a declining rate environment here soon. So everybody that bought a home in the past couple of years will probably be looking to refinance. The VA has put in a couple bumpers, a couple safety measures in their guidelines to ensure the veterans really not getting taken advantage of by some of these unscrupulous lenders. But can you touch on how is the information getting obtained by these other lenders who didn't do their loan to do this kind of sneaky advertising? Why and when a refinance would make the most sense, what the VA has done to help prevent what's called churning, and why refinancing every 6 months just to lower my interest rate a little bit is not the best if I keep getting put into 30 years of debt each time. Can you touch on a couple of those things?
You bet. Well, everything's public knowledge. So what I mean by public knowledge is deed of trust is recorded. So especially in our state, maybe, and there are certain states where it's a little bit harder where they don't report. Like I lived in South Dakota, they don't report, they don't record. You can't have that information. And so there are many, many states. We'll use Arizona as an example. The deed of trust is available. So it's a certain algorithm. You can pay for that information. You can get the name, the property, the loan amount that was recorded. And then you start to get this barrage of solicitation through mail, right? You might even get phone calls. And so when the veteran is receiving those things, the best thing you can do is just put it right in the trash. Because what the solicitation is at a point in time, and I can't remember the specific timeline, Tom, but all they have to do is disclose at this particular timeline, this loan was completed at this rate, you could qualify, right? So they're getting you to call. And a lot of the times what we see with those solicitations or those mailers is the veteran gets it and they're like, well, 4.99, like I'm going to call this guy. Oh, well, you know what? Unfortunately, the market switched today and we're at this, but if I charge you 2 points, we could just finance that in and we could still put you at 4.99. It'd be more like 4 points right now, but we can put you at 4.99. And so we're just financing it in, not a problem. So the VA has put in parameters, and that churning, can't remember exactly what the year was, but before, all you needed, you didn't have to have a timeline. Before that change from the VA is all you had to do is drop the mortgage payment, and that mortgage payment divided into the fees of the loan, and there was a recapture time frame of 36 months. That still stands today, but there was no timeline. So what was happening is all of these mortgages were getting, basically sold or guaranteed, put into the Ginnie Mae bonds, right? Ginnie Mae 1, I think there's pools 1, 2, and 3 now, but put into these pools and then they're selling them off and they're switching them. So what's happening is the VA came in and said, hey, we're going to put a stop to this and we're going to require now a certain timeline. And what that timeline is the veteran has to have at least 6 mortgage payments made. And then they have a timeline of 210 days from the first payment date. So if I closed in April, my first payment was in June, I cannot refinance until I have 6 payments made and 210 days from June 1st, which would be December 28th. So keep in mind of that. Now, can you start with the lender on a refinance if it makes sense? The biggest thing you want to look at is what is the overall cost? Is it efficient for you? Does it lower your payment? Where are you at rate? If you're at 7.5 and you go to 6.25, like, yeah, that's a huge deal. $300 a month. You're recapturing in 21 months or so. Yeah, it's a good idea for that point. You just want to look at the point factors. I think you got title fees, right? Depending on certain states, you have additional tax stamps. There's a lot of those things. So getting with a professional and understanding what that looks like for a refinance. Yeah. So do I think it's a good idea? Yes. I think it's always reach out to a mortgage professional. If you're working with a retail bank before, open your eyes to a mortgage broker. Might be a better option for you when it comes to certain fees, or rates tend to be a little bit lower because, again, we're more like a Costco. See Tom, either Tom's at Costco or I'm at Costco or we're at Costco together. So we go to Costco to do what? We buy in bulk. We want something. We know we're going to use toilet paper. Might as well go get it for lesser amount. So that's kind of what the mortgage broker is able to do. So hopefully that kind of touched your base. But yeah, those parameters are in. I don't know. I don't foresee any changes when it comes to that because it's pretty solid. You've got to drop your rate at least 0.5%. Your fees have to be recouped within 36 months, and you cannot refinance until after the 210th day after your first mortgage payment.
Yeah, I think the 3 key things for veterans to be aware of is interest rate is not the full story. Interest rate,
right?
Fees, total closing costs, not discounting any lender fees or discount points, but also, like you said, title fees, right? Because we're redoing the deed and the title to the home, but then also the payment savings. And so the VA has put in a couple, guardrails on those to help the veteran, but still still it is imperative that the veteran get the details. Don't just take the interest rate and, oh, I got 4.99. Great. I mean, I had a customer send me a loan estimate. It had 5 discount points to get the interest rate that they were getting quoted. Now, we know that won't pass, but the lender was trying to tell them they had to pay some of that out of pocket. And so it's just unfortunate. So the devil is in the details. So making sure you're asking those questions. And Leroy, Tommy, you both can tell, you can agree to this. If you're asking those questions as a veteran or any borrower, and the loan officers are getting squirrely and starting to kind of talk in circles, there's a problem. And so this, again, is something that makes the VA loan stand out. FHA, conventional loans don't really have these guidelines put in place. FHA has some guidelines for streamlined refinances, but conventional, you could drop the rate 1/8 of a point and charge somebody $20,000 in fees and keep refinancing them and keep putting them in debt for 30 years at a time and increasing their loan amount. Like you said, Leroy, they like to broadcast, oh, no money out of pocket. Okay, because we're going to bury all the fees into your loan, and what you owed $300,000 before, now you owe $318,000. And now you're going to might be even getting close to getting upside down in this home just because we lowered your payment $70. And so devil's in the details. Ask those questions. Interest rate is not the full story. Always look at the fees and the closing costs associated with it. And maybe it's not the right time, and that's okay. You want to find a comfortability where you would be comfortable refinancing, and you understand, like Leroy said, here are the fees. Here's how much I save on my payment. It's going to take me 20 months, 20 payments to recoup all of that. And I'm great with that. I'm good with that. I think that's fair. Maybe after 2 years, I might be able to refinance again, but at least now I've recouped everything that I paid into that. So great points, Leroy. Thank you for that.
Well, you got to ask that question, right? The question I would ask if I'm refinancing somebody on a streamline refinance or a cash out refinance, how long do you plan on staying in the property? Because you don't know. Like if they could say, oh, well, 2 years. Okay, then I wouldn't touch it. Why would you refinance? You're just going to pay a bunch of fees. Yeah. It's stripping equity in a position, which is what churning was happening. And so by multiple refinances, title fees and points on it. And so, asking that question, if you're going to be in the property longer than 3 years, because we know that that's 36 months, right? We got that recapture, then yeah, odds that, if rates someday go down, to a point, we look at the refinance, we're going to look at, and we're going to take the cost of the first refinance, we're going to take the cost of the second refinance, and we're going to see what the total recapture is. But if you're going to move in 7 months or in 3 years, then that's a no. Sorry, I'm not going to do a refinance on it because financially it doesn't make sense for me.
Absolutely. Leroy, I know I've got my real estate license, you're a realtor as well. And I'm sure you've heard it in the office, but just there's some agents out there that don't really want to work with VA loans or really work with veterans. How much business do you think somebody's leaving on the table if they're shying away from this vertical or from this channel, from veterans and VA loans? And and just a follow-up, what can a realtor do to reach out or partner with a mortgage broker in order to help kind of grow their business in the VA space?
That's a really good question. And I've been a licensed agent since 2013. And I don't usually practice. I do referrals. I'm still super educated on it. But what I think about from an educational standpoint is if you're selling real estate and you're only focused on conventional or FHA loans and you're not talking about what you do, your first question to the consumer always should be is, are you or your spouse a veteran? Like that's it. That's like number one. And then the next question to the veteran is, do you have a certificate of eligibility? And then the third question would be, is do you receive any disability? Those are the three main questions that I ask every single consumer, no matter who they are. Doesn't matter if they are applying for a conventional loan. The doctor I was talking to yesterday who's wanting to buy a house for his daughter. Well, is your daughter a veteran? Like, always asking that question. I think there's a significant amount of business that can be missed. When I put my agent hat on, if you're not always talking about just serving the client and asking those questions, I think it's a huge opportunity. Obviously, when we look at the biggest growth section, if only 18% of veterans are using a VA home loan that are eligible, There's a huge gap right there of them finding the veteran, doing the veteran. Everybody knows a veteran, right? We've got Veterans Day that comes up, right? We've got Memorial Day, those areas. We've got advocates out there. Everybody knows a veteran, but do they know what you do as an agent and that you serve veterans? What are you doing to educate yourself? Are you going to go to this class in CE in person? Are you going to hop online? Are you going to watch this webinar? Are you going to ask more questions? I think there's a huge opportunity for agents out there to just talk about the VA loan. And I think what comes down to is maybe they're just afraid that they can't answer the question. And that's just not the case. When you're working with an actual true veteran professional, it's a huge difference. There's a stat that just came out in one of the groups that I'm in, Veteran Mortgage Advisors, right? One of the guys in there went back and we've got stats that we can pull through our resources to check mortgage data. So he's kind of a numbers geek. Went through there and it said that the average loan officer in 2023 closed less than, it was 0 to 3 VA loans a year. Well, I can tell you, I can't talk about reverse because you know how many VA or reverse loans I've done? 0. So I'm not going to talk about it. So sometimes when you just go to a class, you got to be immersed. So if I was an agent, I would want to work with somebody and I would ask them, how many VA loans do you close a year? Well, I don't know. It's 90% of my business. Years down, but it's still 90% of my business. So knowing that specific product, right? Renovations of specific product. FHA renovations specific, the 203K, right? Reverse specific product, commercial specific product. The VA is a specific product. So you want to work with the people as an agent that know and understand that VA loan because it can be complex. It's not really hard when you know it, but that's because I know it. But was it hard when I started to understand? It was a lot. I didn't know I could go to 78% debt to income ratio on an approved eligible. Not that that's probably the best option for the veteran, but that's what the veteran was. A single dude. He's like, I'm not worried about it. Like, I'm good. This is what I want. Bam. Going that high on a debt to income ratio was scary for me when I look at it, but it wasn't for him. He's financially sound. Putting a borrower into her first house at a 567 credit score, where when I started at Wells Fargo, we had massive overlays. I didn't know. Came over to the broker world and I was like, oh my goodness, why didn't I do this sooner? Because that could have been so many more veterans that I could help with homeownership. So hopefully that answers your question.
Yeah, absolutely. I think those are all great points.
I think the percentage of your business that are VA loans or VA transactions is important, because one of the things I kind of found most interesting in this business is people who I would regard as VA loan or transaction experts would rarely refer to themselves as an expert, even though they do 90+% of their business as VA loans, because they understand they're learning. The guidelines change. As you talk about, the circular or the VA puts out these updates to the VA guidelines. Nothing is it's a moving target, right? There are changes that happen, and people who don't continue to, get more education and follow up and stay in tune with those things are left behind. Especially as a broker, we have many lenders that offer new programs or updates to programs. And so that's something that would be a red flag. If you have somebody touting themselves as an expert and ask them what's the percentage of their VA loan business, and it's 5%, probably run for the hills. I mean, that's a big thing. Something that I think, and this brings up a larger point, right? If I'm an agent and I want to get educated more on this, and sure, I do want to partner with someone who is very knowledgeable about VA loans, but what can I do as an agent to get more familiar with VA loans from an agent standpoint? I mean, what would you suggest? You're an agent. Tommy's an agent also. What can I do if I'm an agent and I want to get a little bit more versed on VA loans and kind of know some of the red flags? What can I do? What should I do?
Well, there's so many educational resources out there. So I think the first step is educational resources. Now you could grab the 26-7 and go through it, but I don't want to grab a biology book to know about biology. And so that's one of those things. So I think pairing up, paying attention. Obviously, there's a lot of stuff on social media. If I was an agent and I was looking at who's teaching classes, I would probably focus on that, or I'd pair with a lender that even if they're not teaching classes, what do they know? How can you teach me? What can I do? What are the basics? So when I think about being an agent, if I were to go back into just full-time agent mode, I wouldn't be so much concerned about the guidelines. I'd be concerned about what are my questions that I can ask the veteran to make sure they're getting serviced. So it's okay to ask for, hey, so you've been with this automobile company and they just denied you. Do you mind if I ask why? Oh, well, they said my credit score was too low. Cool. What does that credit score look like? You've got to be able to get out of your comfort zone, because I would say we're all lenders here, right? So that's our primary goal, and Tommy and I are agents. But when you look at it, our job is really the numbers, crunching numbers. We do build the relationships, but we're not the relationship person at the beginning. I think that the agent holds the relationship piece and the communication. There's more emotions. Maybe I wouldn't say more emotions, but there's a lot of emotions that goes into home ownership, right? Tom might send me, his loan estimate, and I might really love the conversations with Tom and how he makes me feel good. But at the end of the day, these are the numbers. Tom got me a great deal on my loan. I'm good. We communicate very well. He's probably going to be my mortgage person for life. But when I go walk through that house, I'm walking through that house with an agent, and that's an emotional experience. This is where I see my family or growing up or moving. And so if I was an agent, I would really focus on asking questions as far as resources. There's tons of resources out there. Education, get your butt in the class. Let's talk about it. There's the MRP, which is more of like a physics class, but there's definitely resources of people out there. There's great groups. There's VA Professionals, excellent group. Veteran Housing Advisors, that's another one that's amazing out there. But pairing in alongside of a educated loan officer would be the first step to ask and get a list of questions, so you feel comfortable answering some questions, but you don't need to answer all the loan questions. That's what the loan officer is for.
That's great. That's great. I think we're probably going to wrap it up with this last question. Today we've been talking about all the different myths of VA loans. If you could eliminate one myth, what would be like the biggest myth that you hate, that you think would have the biggest impact, and why?
You can have only one VA loan at a time. Without a hesitation, that's the biggest one. Yeah. And the reason why is because a lot of veterans might have, I would say more of the older generation now, but think, hey, I used my VA loan once, I can never use it again. And that is absolutely just not true. So when we deal with multiple clients, they have a VA loan at some point. The VA has no limit at all, right? So everybody's excited. Oh, conforming loan limits, woo, 2025, super excited. Well, the VA doesn't have a loan limit, right? That's part of the Blue Water Bill. So if I was buying my first house, then I wouldn't have a limit. Now, do they have second tier entitlement, which if I bought a house in, let's say, Idaho, where I'm from or where I grew up, and I wanted to buy something in Arizona, then I'm stuck to the conforming loan limits based off of second tier entitlement, which is bonus entitlement, but I can go way above that if I want to. I just have to have 25% of the difference. So that's what I would probably say is the biggest one I would get rid of, is to focus on how do I utilize my VA loan properly as a primary residence, and through my lifetime continue upgrade or downgrade to a property and hang on to one. And I can do that multiple times. I can have several VA loans. I can have 3 at a time. The biggest thing that I would say for consumers out there, which is huge, is once you start to acquire multiple properties, when you start to refinance those properties to get out of your VA loan to free up your VA loan, keep in mind, it's called a one-time restoration for a reason. That's it. You get one. You get to restore it, get that VA part, say it's a conventional loan, and move it from VA to conventional loan. That's my one-time restoration I can apply for. So I can go buy another house utilizing my VA second tier entitlement or bonus entitlement, but my restoration at that point is done. I can petition for more. VA will allow me to, but people have to think about that when they're buying multiple properties, as at some point you'll start to have to liquidate those if you're wanting to utilize the VA loan, in the future.
That's awesome. Thank you so much for coming on today. Do you have any other questions, Tom? Or
no, I think that answers a lot. This was a lot of great information. Hopefully, it helps a lot of people and helps continue to change the thought process behind the VA loan.
All right. I appreciate both of you. Have a great day.
Thanks, guys.
Thanks for having me on.